All right. All right. Good morning, everybody.
Good morning.
All right. Misha, if you would call roll.
Laura Bellin,
Present.
Landon Moore,
Present.
Danny Covey,
Present.
Mark Gardner,
Here.
David Harrington, David Holly, Mark Munson,
Present.
Solomon Ashby. Was here. Derek Challenger,
Present.
Shannon Glover, Elizabeth Gooden,
Present.
Cheryl Spivey. Here. Solomon asked me to be on record.
At 8:33.
We have a quorum.
Thank you so much. Let's see. Misha sent the minutes out earlier this week. And if you've had a chance to review them, I'll entertain a motion to accept, or if there are edits, speak now.
Move to accept the minutes as presented. Second.
All right, all in favor?
Aye.
Aye, motion is carried. If you would, go with the applications for retirement.
Miss Gooden's
Oh,
gonna.
that's a jump to me that quick. 30 minutes. Good morning.
Good morning.
We have two in here. We have the ones from the April meeting that we didn't have for the fire and police. We have Matthew Crutcher. He actually retired. We have Ronald Tharrington, who's vested, and we had two reported deaths. We had James Madron and Mario Covertino Jr. For May. This one is pending. We have Sergeant Walker, who's looking to retire. We also have another vested person, who is David Henley. You'll also note that you'll see that there was a vested retroactive payment with interest that was paid out to him. That goes back from April 1st of 2013. And our active participation as of May for our fire and police retirement system, we have 16. And for our Portsmouth Supplemental Retirement System, we have 15.
No, I don't recall seeing the vested on the list before. Is that new, or is that, have I just overlooked it?
Maybe just, we've been putting them up there for a while.
Oh, okay.
I don't know for how long. Maybe since,
not had any for a
maybe
while.
since I've been back
Okay.
a second time.
All right. Maybe not that many. Good morning.
Good morning, Sheriff. You were in executive session.
All right. Thank you.
You're welcome.
And the historical.
Okay. So turn into page 6 in your packet. We'll first take a look at February, where we had the activity in February was $98,733 of interest income. We had some small return of benefit payment, $720. The recurring, the $720 was a payment back, a return of payments. The recurring benefit payments of $2,447,783. Had some realized gain and unrealized loss and unrealized gain. The loss being $19,522, and the gain being $5,290,521. Then we'll turn the page to page 7, and we'll look at the activity in March. The interest income was $433,551. Administrative expense of $23,044. The recurring benefit payments of $2,470,400. And then we also had realized and unrealized gains and losses. The realized loss was $1,392,741, and the unrealized gain was $4,765,751. If you look to the year-to-date column, you'll see that we now, at the end of March, had a balance of $209,135,895, which compared to this time last year is down from 222 million. So a decline of about 13.
So,
Right, is that right?
All right, any questions for Ms. Spivey? Thank you. All right. The other new businesses, the OPEB trust update.
The statement, the February and March statements are in your packet. The March statement is showing a balance of $3 million, this is on page 14, $3,997,415, and that's reflecting the $1 million transfer for fiscal 19. Other questions on the OPEB balance statement itself?
Keisha mentioned that she has available for anyone who might want it.
These are the agreements for the OPEB trust, the board, their final agreement with the amendments that she's going to go over in a minute. So if anybody wants a hard copy, I do have them.
All right, thank you.
Actually, Derek, did you want to do the amendments?
You can do it, but I had one little thing I wanted to add with the OPEB is that the NACE annual meeting will be in Richmond during September or October. And I remember we had a discussion earlier about who is it that's supposed to go. And there's a session of the agreement that we have with them that specifies that a local finance board may designate one or more, but less than all, of its members to serve as the authorized representative of such local finance board for purposes of this agreement. So we have the ability to designate one person who's a member or multiple people, as long as it's not the whole entire local finance.
You are connected to the conference.
So, and I just want to let you know that because obviously September and October will be here before we know it. And I just want to make sure everybody has an opportunity to think about that between now and then so that we can be present at the NACE annual meeting.
But we don't have a specific date.
No, this correspondence that I got was back in November of last year when we had the question about the annual meeting in the first place. So I assume at some time during the summer they will get an exact date. So this might be the trigger for me to write back now and find out whether or not there is a date that's already scheduled.
Right. If you can find a specific date, I guess then we'd be better able to plan. I would think one of the members of the investment committee might want to attend. Not sure, but we have this week to think about it. Unless you all have some other suggestions or comments.
Welcome to the Morgan Stanley audio conferencing system. Please enter your host
That
or
would be great.
participant code
And we'll get-
followed.
Hopefully we'll have a date. Thank you,
Morning.
Ms. Challenger.
No problem.
So there were 3 proposed amendments, and I really know no more about these than what we have on the sheet of paper, but it's regarding the nominations of who could be on the board.
Page 22.
This is page 22, yes. Thank you. And so those, I think you said those amendments have been incorporated into the document that was distributed. Any questions on that?
No questions? Okay. Move right on.
All right, I think you guys are up.
John Hancock, invoice, I'm sorry.
Okay,
I
on
missed
the,
one.
on the invoices, so the most recent invoices are attached, and we did include, this time, the calculations of how the invoices are calculated. We do receive that with each invoice. I guess we just hadn't been putting it in the packet before. So, if you have any questions, we have the right person here today to be able to assist.
Just as a matter of interest, they're showing on the website, it will be the Virginia Local Government Investment Conference will be held on Friday, September 27th, 2019, Richmond Marriott Short Pump. And it says the OPEB Trust will hold their meeting prior to the big meeting beginning at 9:30.
Okay, so if you would check your calendar for that date, we'd appreciate it, Lynn. September 27th. All right, and back to the
That's it.
invoice.
Right. Anyone have any questions?
Are these charges relating to the current contract? Are they in agreement with the terms of the contract?
Yes, they are.
Yeah, you want, so the way this works, so I provide the other, a slightly different version of this on a quarterly basis that I'll show again later later this morning. But our rate, we charge a 6.5 basis point rate. That's part of our agreement dating back just short of 5 years ago.
Yep.
And this is essentially just, it's done on a daily basis. So it takes a 6.5 rate and applies the number of days in the quarter versus the average assets during the quarter to come up with the dollar amount.
All right, if there are no questions, like a motion to approve?
Move to approve?
Any objections? All in favor?
Aye.
Oh, did we get a second? Sorry.
Second.
Thank you. All in favor?
Aye.
All right. And Brian and Jim, welcome.
Good morning.
Good morning.
Great to be with you. Thanks for arranging for a sunny day as well. We were talking to David up on the elevator, and we got 6 inches of snow in Chicago 2 weeks ago, so it's nice to be here.
Wow. Yeah, it's lovely here.
On the phone, we have some folks from our outsourced chief investment officer group. As you all know, at the end of last year, we changed our relationship to be a discretionary mandate, and at that point, we brought in some additional resources from New York, and we're working with them to build out the portfolio and restructure the portfolio. We're going to talk about some of the changes that we made over the last couple of months and where we go from here. We're going to talk about the capital markets environment during the first quarter of 2019. We're going to talk about our outlook for the remainder of the year and looking forward. And then we'll also talk about the results for the pension plan. We're going to focus on first quarter of 2019 results, but I'll give you an update for April and May as well. So I guess I'm going to start on page 1. Capital markets overview. And as I was coming down yesterday, I was trying to think if there was maybe a word that I could use to describe what's been going on in the capital markets over the last several months. And what occurred to me is that I think a lot of what's going on right now, a lot of the volatility we're seeing in the first part of May here is really a function of what's going on politically. So I tried to think of a political word. And it's not quite a word, although I think it's probably hyphened, but I came up with flip-flop. And so what does that really mean? So there's at least 3 examples where I think the capital markets or the economy or what's going on sort of geopolitically has flip-flopped over the last several months. The first one, most obvious one, being when we look at fourth quarter of 2018 results and compare it to the first quarter of 2019. Fourth quarter of 2018 was the worst quarterly return for the S&P since 2011. The S&P 500 in the fourth quarter of 2018 was down 13.5%. Now, there's a lot of reasons for that. We talked about that when we were together in February, but what's happened since then? There was a dramatic recovery in the S&P 500 in the first quarter. We're up about a little over 13.5%. So the math doesn't quite work right. When you're down 13.5% and you're up 13.5%, that doesn't mean you're flat, but interesting that one quarter we were down 13.5, the next quarter we were up. So that's kind of my first instance of flip-flop. The other change that occurred, and this was maybe a little bit more recent, was what's being termed the Powell pivot. So towards the tail end of last year, and this is kind of what drove part of the reason why stocks were so weak at the tail end of last year, was because the chairman of the Fed, Chairman Powell, talked about the fact that interest rates were going to continue to rise. The Fed was going to be on its path of normalizing monetary policy. We get past December and into the early part of this year, and he said, well, hang on a second, maybe not. We're going to keep rates pretty steady for the time being. We can argue whether it was in response to the president's tweet saying we should not only should we not be raising rates, we should be cutting rates, but nonetheless, the Fed has changed policy. That's changed their position. So a lot of that change in monetary policy and the position of the Fed is sort of the impetus of rising equity markets that we've seen here in the first quarter. And then the last example of this notion of flip-flop is what we're seeing in real time right now. You listen to the president or read his tweets in the administration, and we've got a deal with China, and now we don't have a deal with China. So there's a lot of uncertainty, and that's what's really driving the declines we're seeing in the first part here in May, and we'll talk about the magnitude of those. But I just wanted to give you a sense as to what we talked about last time we were together and the very weak capital market returns towards the tail end of last year. We've got the sort of the mirror opposite in the first quarter. Now it remains to be seen how the rest of the year plays out. We'll talk about some of the things we're thinking about and portfolio positioning to take advantage of that. But I just thought that helped me think about the last time we were together versus where we are today and how different the environment is. If you flip ahead to page 3, the table at the bottom of that page there shows the returns of the major capital markets over various time periods. We show the first quarter of 2019 and then for longer term periods. The S&P 500 was up a little over 13.5%, 13.65% for the first quarter of 2019. Small cap stocks, the Russell 2000 index, did even a little bit better. They were up about a percentage point more, 14.5%. That's obviously a big recovery from where we were. I think the sort of the trough of the market in December of 2018 was actually Christmas Eve, and at least through the end of the first quarter from that low to where we ended the first quarter, we were up about 20%. So the recovery that we've experienced from those dramatic declines in the fourth quarter of last year has been pretty remarkable. We actually think that the market's gotten a bit ahead of itself. Having a 14% return in one quarter, that's a big move. So it's not all that surprising, even in light of sort of the on again, off again trade deal with China. It's not all that surprising that we're seeing at least a pause in the rise in equity markets here in May. Just to give you a sense, everything was up in the first quarter. Technology stocks did the best, but even the more defensive sectors, things like utilities and consumer staples, experienced pretty dramatic rises in value. So it was a pretty broad-based recovery that we saw, which is good in the first quarter of 2019. The other thing I'll point out, and it's not listed on this page, there's this, you could, as a general rule, you could lump stocks into two different categories. There's growth stocks and there's value stocks. And the difference between the two, growth stocks are growing their earnings. Think about companies like Amazon and Microsoft, technology type companies that are growing their earnings and revenues faster than the overall market. Those are generally termed growth stocks. Then you've got, on the flip side, value stocks. Value stocks are stocks that the market doesn't necessarily sort of appreciate the earnings power or the sort of the value of that company. And so they tend to be slower growers. They tend to be cheaper stocks. There was a pretty big, there's been a big trend over the last several years of growth stocks sort of dramatically outperforming value stocks. And it's been a very, very long cycle. And these things can last for a very long time. Growth stocks in general were up about 16%, value stocks were up about 12%. So I just want to kind of give you that context. Both very good returns, but growth continues to do, those technology type stocks continue to do better than value stocks. On page 4, the strong returns were not exclusive to the U.S. equity market. On the bottom table on page 4, the MSCI EAFE index. This is an index of developed non-U.S. equity markets, places like Japan, continental Europe, Australia. Those markets were up a little over 10%. So a little bit less than what we saw in the United States, but still a strong result at north of 10%. And then if you go all the way down to the bottom of that page, emerging markets, and we'll talk about some of our exposure there, emerging markets were up 10%. Now we've got a healthy weight there, so that we're overweighted. That over allocation didn't necessarily help us because emerging markets in general underperformed the U.S., but when I show you the results of the emerging market manager we have, it was the highest returning manager in the program. So they did an exceptional job. Not only did they beat the emerging market index, but they beat the return handily of the U.S. equity market as well. So we'll talk about that. That really helped our results when we get into portfolio results. Last thing I'll say on capital markets, and I'll turn it over to Jim to talk about outlook and get into the portfolio after that. On page 5 is just a quick snapshot of different fixed income market returns. So bonds were up just under 3% in the quarter, 2.94%. The reason for that is really a function of this notion of the Powell pivot. At the end of last year, the expectation was rates were going to continue to rise. And when Chairman Powell came out and said, no, we're keeping rates steady for a while, interest rates actually declined. So if you look at 10-year Treasury bond yields, they started the year at about 2.4%. They ended the first quarter at, they started the beginning of the year at about 2.7%. They ended the first quarter at 2.4%. So interest rates declined during the first quarter, and that's good for bond prices. That 3% return pales obviously in comparison to equity market returns, but I can assure you a 3% return for bonds is a really, really good number. The other thing I'll point out is right below that, so the second row in that table at the bottom of page 5, the Barclays Capital High Yield Bond Index. Now, we don't have any exposure here, but high yield bonds were up over 7%. High yield bonds act an awful lot like stocks, more so than traditional bonds. So when the equity markets are strong, it's very common to see high yield bonds rally in tandem with what's going on in the equity market. So that 7% return was quite strong. We think there isn't a heck of a lot of value in the high yield bond market because the extra yield that we get from investing in those bonds does not really compensate for the potential risk that those bonds bring to the portfolio. In fact, we'd rather own stocks than high yield bonds. Given that they tend to move in tandem and in the same direction, we think the upside from equities is a lot stronger than what's being priced into the bond market right now. So I'm going to stop there. Jim's going to pick it up from here to talk about outlook, and then I'll come back and talk about portfolio results in the first quarter.
Hi, Suzanne. Team, welcome.
Hi, guys.
How are you?
Good morning.
Good morning.
Wonderful.
Good. Anything, Suzanne, you'd like to add or discuss this morning with the committee?
No, I think Brian summarized the first quarter incredibly well. We're here to answer any questions around performance and on outlook if necessary. But thanks for the shout out.
So just so everybody here knows, Suzanne and her colleagues, we work hand in hand with that team in New York. She's next to all of the resources we have at Morgan Stanley. We have regular calls about the markets, about the portfolio, about managers, about rebalancing and weightings. Suzanne will be joining us at some of these meetings. We thought we'd get the portfolio more developed with the new investment policy statement. I know Suzanne's got some new risk metrics that she's dying to go through with you. So when the portfolio gets fully transitioned, we expect to go through that information. Anything else you'd like to add, Suzanne?
No, I think that's great, and I again look forward to meeting you in quarters to come. I'll jump in as necessary, and again, here to answer any questions regarding specifics around the portfolio direction, and the risk metrics and the risk management that's embedded in the portfolio today.
Great, thanks. Just so everybody knows, there's a deeper team than just Brian and I. We love to be here, but there's more of us behind the scenes. Thanks, Suzanne. I'm going to go through some of the economic slides. I'm going to start on page 8 with this color, very red and green-looking chart, very colorful. What we're looking at here is the asset classes that outperformed or underperformed the rate of inflation. So red box means that asset class underperformed the rate of inflation for last year. And the green, of course, means it outperformed. This goes back to 2008. So rate of inflation about 1.8%, 1.9% for last year. Pretty low bar for asset classes around the world to beat. And yet, if you look at what happened in 2018, of all the major categories that we follow, not one of them beat the rate of inflation. And most of this was given up, as Brian mentioned, in the fourth quarter and in December in particular. So the message here for 2018 was just don't fight the Fed. The Federal Reserve is raising interest rates, raised interest rates 4 times last year, 9th in the campaign. And that really spooked investors in the United States and around the world. And Brian talked about Chairman Powell backing that off. But 2018 was pretty rough. And if we would have just said don't fight the Fed, it would have been pretty clear. The interesting thing is the flip-flop in 2019 is as soon as Chairman Powell backed off the interest rate hikes, it was just the opposite. It was risk on. So every category outperformed the rate of inflation. And if we look at one of the riskiest categories, the very bottom in 2018, China equities, which was one of the worst performers. And we look at 2019, and investors are willing to take risk again. We see that that's one of the top performers. Any questions about that slide? Let's look at slide 9. About 6 to 9 months ago, we were forecasting a pretty significant deceleration, almost an earnings recession, after we had 3 quarters of almost 25% earnings per share growth in 2018. And now we're seeing a very sharp deceleration, which was our forecast. So we think that this is going to be a choppy period for the stock market. So more volatility. Our price target, which we'll talk about in a minute, for the S&P 500 is actually a little bit lower than where we're at trading today. And a lot of it just has to do with this deceleration in earnings. Now, we do see a recovery, as you can see on the far right, but it's one of the reasons we think equities are fairly valued in the U.S. today. Looking at this a little bit more deeply on slide 10, this is our proprietary leading indicator of earnings. So what we're looking at here is the blue line is the actual S&P 500 year-over-year EPS growth for the last 12 months, and the yellow dotted line is our leading earnings indicator. So the indicator, which has done a really good job for us back to 1989, is telling us what we're going to see for the next 12 months. And you can see there's quite a bit of a divergence between where the blue line is, the actual, and the leading forecasted number for the S&P. So it's still turning down. It's negative. We don't think this is a terribly big deal because it's not anywhere near where it was in prior recessions, but there's a big gap. So this confirms for us our thinking that earnings will be a pretty tough hurdle for investors. On slide 11, when companies report earnings, we screen for certain words, and this is a service that we pay for. And in the December quarter, we screened for labor costs. And what you can see here is that companies are clearly speaking more and more about labor costs and have more concerns about labor costs than they have in the past. So in the last quarter in December was the highest that we've seen going back to 2005. And why we're focused on this is because labor pressures start to eat into margins. So we screened for various words, various quarters. I thought this was particularly interesting because of the spike in labor costs. Probably the two questions we get most often are we in a bull market? Are we in a bear market for equities and for bonds? So these last two slides are meant to address that. And the conclusion is quite different. So on slide 12, what we're looking at is a cyclical bear market, which is shorter term in nature, versus a secular bull market, which is very long term in nature, 10 to 20 years. And what we're looking at here is the green line is a 200-day moving average of the S&P 500, and the red is the 200-week moving average. So much different average. And we note here that the oval circle in the middle was the last time we had a secular long-term bear market. And then since then, we've had 3 cyclical corrections within a bull market. And what we've noticed is that cyclical bear markets break the 200-day moving average, the green, but they do not break the 200-week moving average. So for us, this just means that the correction that we saw in December is a cyclical correction and not the beginning of a secular bear market. So while we think equities are probably fairly valued in the U.S. at this point in time, we're not overly eager to reduce our equity exposure, because what we want to do is compound and grow during these secular bull markets, and that's where we still think we're in. The time you really want to head for cover is during these secular bear markets, and that's not what we think we're in today. If we look on the
Thought on when one may start?
Our view is we'll likely have a recession, but we just don't see a secular bear market on the horizon. All of our leading indicators.
Horizon being 24 months
Yes,
or more? Okay.
24, exactly right. But because of the earnings deceleration, it could be a rocky ride in a cyclical correction. Let's look at bonds for a moment. The flip side to the equity cycle is the bond cycle. So we get the same question about interest rates and yields and whether we're in a secular bear market or not. So what we're looking at here is the 10-year Treasury yields, nominal. And beginning back at the left of the slide in the 1980, 1984, the Reagan-Volcker era, this began this beautiful downward trending secular bull market for bonds, meaning prices were going up and interest rates were going down. So in this channel that we created, note that there are lower lows, and then we have this double bottom you can see with the two red arrows on the right, starting in 2012 with the end of quantitative easing, and 2016 with the introduction of the Trump administration tax cuts. So for us, this signaled a shift. This double bottom, lack of a lower low, was a signal of a shift. We broke out of the upper end of that channel. And so for us, we think we're going to be, after the next recession, most likely, we'll be in a secular bear market for bonds. It'll take years for this trend to develop, but our view on interest rates long term are quite negative.
Bear markets for bonds are different than bear markets for stocks. I mean, the worst, I think 1994 is still the worst annual return for the U.S. bond market, and that was down like 4%. It doesn't mean it can't be down 10 or, more than 4, but it just kind of gives you some context and compare that to, what the drawdowns we saw in equity markets in 2008 were down, 30+%. So although we talk about bear markets and bull markets, the impact on us and what we do to sort of mitigate some of those declines, the magnitude of those declines are very different.
It does pressure other financial assets because the hurdle rate, the risk-free hurdle rate goes up. Just to close on this, we do think that we're still in I don't mean to confuse it with secular and cyclical bull market, but we do believe that we're still in a cyclical bull market as things consolidate, and we probably will move into a recession at some point. So we don't see this move up in rates happening anytime soon because we're so late in the economic cycle. But if we're looking out over the horizon, that's our view.
Questions about the outlook before we come back to the first quarter? Talk about portfolio results? Yes.
Well, in listening to you, you're talking about, your name's Jim?
Jim, yep.
Jim, you just talked about a recession is possibly looming, right? Perhaps. So what are some of the safeguards you can put in place to kind of minimize and mitigate that?
Well, we do two things. One is we've worked with the investment committee to do this. We create a long-term strategic target allocations, which we're still moving to. If we feel the probability of a recession is rising, we can adjust tactically the portfolio to make it a little bit more defensive. We can reduce equity exposure. That's pretty easy for us to do. Increase our bond exposure or increase our cash exposure, or alternatively switch into asset classes that have a much lower correlation to global equity prices.
Other questions?
Any other questions today?
So let's talk about the good stuff. Page 16. We show 3 different time periods here. And this is at the total fund level. We show the first quarter of 2019 on the far left. In the middle there is something called the custom period. The custom period is the point at which our relationship changed over from where we provided advice to the board to where we took discretion for making the investment decisions. So that clock started on November 1st of 2018. So we show that period in the middle. And then performance since inception, this is the point at which our team came over from Credit Suisse. So we joined Morgan Stanley in early 2016. Keep in mind there was a very different structure with different advisors in place. I mean, we show that because, well, just because, it's relevant. But keep in mind that we didn't have control over the entire portfolio for that whole period of time. The results, quite frankly, over that since inception period are still good. We're beating the benchmark there by about 40 basis points, so almost 1/2%. And importantly, that return is beating our actuarial return assumption of 7.25%. So it's a good result since early 2016, but I'm not really going to talk about that. So year to date, how did we do? Well, we started the year with about $188 million in assets. We ended the quarter at over $206 million in assets. We paid people their benefits and plan expenses during the course of the first quarter. Obviously, that's what we're here for. So that was about a $2.7 million outflow. But the earnings that we had from our investments were up almost $21 million. So you take all that into account, what does that mean in terms of a percentage return? In the first quarter, given the strength in equity markets, we were up a little over 11% in the quarter, 11.04. And we're going to talk about why we were up that amount, particularly with respect to our benchmark, which was up 9.8%. Why were we able to beat our benchmark by over 1% in the first quarter? We're going to talk about that in a minute. That middle period, that custom period, again, this is reflective of our discretionary mandate. We're up 7.4% versus a benchmark of about 6, so 145 basis points of extra return. Now, the benchmark is simply a measure of, it says, if we were on our investment policy targets each and every day, exactly at those targets, and we earned the asset class benchmark's returns, what would that have been? And that's what the benchmark is. Now, the reality is we're not on targets each and every day because there's volatility in the markets. And this isn't to say that we're taking a view on one market versus another. It's just, the relative performance of the different areas of the market means that our portfolio is not always going to be on our investment policy targets. So that's one factor in why our return could be different. The other factor, and quite frankly, this is what happened in the first quarter, is that our active managers did really, really well in the first quarter. We're going to talk about some of those. Just to give you a sense as to...
Would the benchmark be City of Portsmouth? That's the benchmark.
That's correct, yeah. Just to give you a sense as to how April and the first week of May was looking. April, these are back of the envelope calculations. We'll get, final things here probably in the next week or so. But the month of April, we're up, our portfolio's up another 2.9%, so almost 3% in the month of April. Our benchmark was up about 2.3%, so we're, the excess return that we're generating relative to that benchmark is expanding, which is great, at least expanded in the month of April. The first part of May, we're down about 1.3% in the first week of May. This was through the day before yesterday, whatever that was, May 7th. And we're down about in line with what our benchmark is, maybe a little bit more than what our benchmark is. So you add all that together, and year to date through the day before yesterday, we're up over 12.5% for the plan. Benchmark's up about 11. So, about 160 basis points or so of excess returns. If you flip ahead to page 17, this takes a look at how, at a very high level, how the portfolio is allocated. So as I mentioned on the prior slide, the table on the bottom of that page there breaks out the asset allocation by asset class. Again, we ended the quarter at about $206 million in assets, a little bit more than that. The chart on the top of that page just graphically shows that. So we've got about 70 to 75% of our portfolio in equities, global equities, those in the U.S., large cap and small cap, developed non-U.S. markets, emerging markets. About 70 to 75% of our portfolio is allocated there. We've got an allocation here to alternatives of about 3%. That's predominantly real estate investment trusts. We'll talk about our plan for those, but in the scheme of alternatives, it's not really an alternative. It's more stocks. They trade on the stock exchange, but it's real estate that's backing those. And then about a quarter of our portfolio is in fixed income. So I want to talk a little bit about what we've done in the first quarter of 2019 to restructure the portfolio. So there's really four things we did, but the one thing we didn't do was we really didn't change the underlying exposures. We changed out some managers, but that roughly 70 to 75% in global equities has been relatively constant. So we didn't reduce equity exposure, we didn't increase fixed income exposure. What we did was we swapped out some managers. So one of the things we did was prior to the first quarter, we had an investment in two bond managers that we no longer have. One was a global bond manager, it was Templeton. Did very well for us, but we sold out of that. We terminated that portfolio and invested more in traditional U.S. fixed income. So still bonds, a little bit different strategy, lower risk. We moved from a higher risk fixed income manager to a lower risk fixed income strategy, but the underlying exposure is effectively the same. The other thing we did was we had an investment with a manager, a fixed income manager called Reams. They're based in Columbus, Indiana. We had an investment in what's called an unconstrained bond strategy. Now, what does that mean? Unconstrained bond basically means they can go anywhere in the global fixed income markets and buy whatever bonds they want. So we exited out of that position and again bought more traditional, more defensive, traditional U.S. fixed income securities. So the bond allocation stayed the same, but we shifted a little bit of the investment managers and got a little bit, arguably, more conservative. The other thing we did was when we looked at, once we got out of the Schaefer-Cullen portfolio, all of our U.S. large cap equity exposure was in an S&P 500 index fund. And that did really well for us. It goes down, it went down in tandem with the market in the fourth quarter of last year, and then it rallied a very similar amount in the first quarter of this year.
When you're saying bonds, you're talking bond funds as opposed to individual bonds, correct?
We got out of bond funds, and what we invested in were individual bonds, but it's managed by a firm called BlackRock, so it's professionally managed. But they're buying individual bonds on our behalf.
Bonds, okay.
Yep.
It's a separate account?
Separate account, yep. The other thing we did was we added some active management in large cap U.S. equities. We hired a growth manager and we hired a value manager. The growth manager's off to a pretty good start, we'll show you, outperforming the market. And the value manager is much newer, and so they're lagging a little bit. But we think the environment with higher volatility that Jim talked about is pretty ripe for active managers, which is why we added those positions in the portfolio. The third thing we did was we replaced our small cap value manager. So prior to the first quarter of this year, we used something called the Goldman Sachs Small Cap Value Mutual Fund. It's more of a core type manager. Earlier we talked about the difference between growth and value stocks. If you think about it as a spectrum, you got on one side value, you got on the other side growth, and then in the middle is something called core, which is basically a blend of those two. Goldman Sachs was more in the middle of that spectrum, maybe tilting slightly towards the value side. So we replaced them with a separate account manager buying individual stocks on our behalf that is much more value oriented. It's a better complement to the growth manager we had in place. So we made that switch in the first quarter as well. And then the last thing we did, you may recall that we had a very small allocation to something called the AQR, I think it's managed futures or absolute, I forget what exactly they call it, but it was a mutual fund. It was basically a managed futures portfolio. And basically the way that works is markets are trending, they're buying the stuff that's going up and trying to sell the stuff that's going down. It's typically a hedge for weak equity markets. It did okay in the fourth quarter, but the allocation we had there was like 2% of the total fund. It was very small. We swapped out of that. We got rid of them with the idea in the next phase of this transition, we're going to have things in the portfolio that protect much more than this investment did when equity markets are weak. So those were the four major shifts that we made. Again, not shifts in exposure, but really more shifts in the underlying managers we're using. Now the question is what's left for us to do, I think. And there's 4 things that we're going to be looking at and changing here in the near term. One of the things we're going to do is, as I talked about earlier, we've had a big overweight to emerging markets. Now, emerging markets in general have lagged the developed markets, but the manager we've had in place has more than added enough value relative to not only its benchmark, but U.S. equity markets. We want to reduce some of that exposure, kind of lock in some of those gains that we've experienced. The other thing we want to do is we want to add a second emerging market manager to the mix. We'll likely have 2 active managers instead of the 1. Our plan is to move out of, I talked about this alternatives exposure being public real estate investment trusts. We're going to move out of that and move into some private real estate. It's a very small allocation. But we think the opportunity there is better than what's available in the public market side. And then the 4th thing, and the board approved this and is reflected in the investment policy statement, we're going to be implementing a very, very small, conservatively managed hedge fund allocation of about 5%. So we've done 4 things. We've got 4 things left to do. Markets are dynamic. Things change daily. So the timing of some of those changes may shift based on what's going on in the capital markets, and the capital markets may provide us opportunities in the future that we're not really thinking about right now, but rest assured we'll take advantage of those. So let's talk about individual managers on page 19. And I know this is a little bit challenging to read. There's a lot of numbers here. I'm just going to...
Can I interrupt you for a second?
Yeah.
Regarding the allocation, did you purposely not put the policy allocation on here?
No.
On 17 or somewhere?
No, we did not.
And just generally speaking, I think we're roughly a 70-30 target, so
Yep.
we're a little bit overweight equities, and it sounds like you're maintaining that position.
Yep.
And then you talked about growth and value earlier. I know growth, as you said, has outperformed value for a long time. Have you positioned it so that we're sort of overweight value now? Or do you believe that value is going to come back?
We think that value is going to turn at some point. Yes, the answer to your question is we do have a slight overweight to value at this point. And if you flip ahead to page 21, I'll just kind of show you what that overweight is. So that first row in this table on page 21, Poland Capital, that's our large cap growth manager. For us, they're managing a little over $8 million. Right below that is Aristotle Value Equity. So this is a large cap value manager. They're running about 12.6 million. So you can see, in general, if you don't have a view, you'd have about 50% invested in each manager. You can see by the fact that our allocations are slightly different that we've got a slight overweight to value stocks.
All right, 2 more quick questions.
Yeah.
Active versus passive. I know active has had a tough run,
Yep.
particularly last year.
Yep.
It sounds like the manager you picked, at least recently, in this quarter, outperformed. Did active overall do better in the first quarter this year, or did we just happen to have high-performing managers?
We've had high-performing managers, and the success of active management varies on a quarter-by-quarter basis. Over long periods of time, certainly in certain markets, things like large cap U.S. equities, for example, it's really, really difficult for active managers to have value. We think there's a cyclicality in that. And the environments where active managers tend to do better are those environments where there's more volatility. So we're in that period right now where there's more volatility in markets. And we expect we're in a period, we don't know how long it's going to last, but that we're in a period where it should be more fruitful for active managers. But pretty much nobody at the tail last year, no active managers outperformed. I think active management, in general, did a little bit better in the first quarter of this year, but our managers did particularly well as well.
And the last question, the manager changes that you've made,
Yep.
has that been kind of fee neutral?
No, it's been a fee reduction. So I think I flipped in some Atan stuff. It looks like our overall fee is about 39 basis points for the overall plan, which is
Before
pretty
your
attractive.
fee?
Does that include ours? No, okay, yeah.
Okay. So it's still under 50?
Yeah.
All in?
Yeah, for sure. So let's go to page 19 and talk about, and I apologize that this is a little bit challenging to read. If you go down 1, 2, 3, 4 rows there, you'll see something that's called, don't ask me to tell you what this stands for, UD Portsmouth Supplemental Fire and Police, and then it says American Euro-Pacific Growth. You see, does everybody see that one? So this is one of the active, developed non-U.S. equity managers we have in the program. We've had this investment for a long time. It predates Jim and my involvement with the city, but we've kept it because they've done a nice job for us over a long period of time. And you can see if you go through to the quarter's results, they were up about 13.4%. They beat the benchmark of 10.3%, so they've outperformed in the first quarter by 300 basis points, or 3%. This is a manager, it's a large organization, so anytime you get really big, we get concerned about their ability to add value, but they're really consistent. They do it in lots of different environments where they've shown an ability to outperform the market despite their size. They had a fairly significant overweight to technology stocks. They picked good stocks really in all sectors of the global economy, and in particular in Brazil and Japan. So broad-based success across that entire portfolio. The one right below that is this Artisan Developing World Fund. So this right now is our sole emerging market equity manager. And I sort of alluded to that, they did really well. If you look at the first quarter, they were up 23%. The benchmark, the emerging market index, was up 10%. So they outperformed in the first quarter by 13 percentage points. So that overweight we had, although emerging market stocks didn't do as well as the U.S. equity markets or developed non-U.S. equity markets, this manager more than compensated for that. So that overweight that we had to this manager is a big reason why we beat our benchmark by about 150 basis points at the total fund level in the first quarter.
And just to add to this manager, we just did our first quarter review. This is the type of manager that we like because the market sold off very hard in the fourth quarter. Brian mentioned the December sell-off. And what this manager did was he repositioned the portfolio into his favorite names. His favorite names that had become overvalued during the course of 2018. So pivoted, repositioned, and then and we saw the snapback take place in the first quarter. So he owned his favorite stocks that were previously more expensive, got very cheap, turned over the portfolio, and this is the result of that. So if we're going to have active managers, because there's always this debate about active versus passive, and we'll be talking about this for years to come. There's no question about it. But what we're looking for in managers, if we're going to use active managers, is exactly that kind of behavior. What is not appealing to us is we go through a dramatic sell-off and the manager has the same set of stocks coming in and coming out of that. Right? There has to be some value proposition to get these kind of results. So that's what we're looking for in the active space. Otherwise, our decision will be, let's just go passive and get the cheapest allocation where the fees are the lowest for the portfolio. So I just want to highlight the types of managers that we're looking for.
And over that custom period, this manager's up 26.5%, again, versus that benchmark of about 11.5%. So really, really strong results from this, this investment that we've had. If you go a couple lines below, you'll see something called Lazard International Equity. This is a relatively new manager for us. We, I think, put this manager in place probably a couple of years ago, but this was one that, that Jim and I had recommended and the board approved. In the first quarter, they were up, this is a developed non-U.S. equity manager, they were up 13%, 13.1%. Again, the benchmark up 10.3, so almost 300 basis points of excess return there, and you can see over the longer period of time they've done well for us as well. The lone challenged manager for us is Rice Hall James. This is our, which is right below that Lazard portfolio. This is our small to mid-cap growth manager, and they were up 10%, so not a bad result when you think about it in absolute terms, 10% for a quarter, but the index was up 19%, so they underperformed by 900 basis points. So what was really driving that underperformance? They had some stock selection that didn't quite work out for them, but the reality is it was more about the stocks they didn't own. So Rice Hall James has a valuation component to their process. So yes, they invest in growth stocks, but they don't want to pay too much for those growth stocks. So anytime you have a market that runs sort of arguably indiscriminately, like we did in the first quarter, they're going to underperform because they are not going to be investing in those high-flying stocks. And that's, by and large, what happened in the first quarter. It doesn't explain their, longer-term result, but that's what really drove the result in the first quarter. They got more defensive, and particularly in the biotech sector, where there were a lot of acquisitions that happened during the first quarter, companies that maybe didn't really have earnings, or some of them didn't even have revenues. They're just not the kinds of companies that this manager buys. So that's what was driving that result there.
How long do you retain a manager before you decide to let him go?
Yeah, that's sort of the art behind what we do in consulting. We don't have a hard and fast rule. What we try to do across the board is to see if what is driving the underperformance. Sometimes you can identify explicit things that drive the underperformance. Sometimes it's somebody leaving the firm. Maybe the firm sells itself, they lose, or they change their process. Those kinds of things cause us a lot of concern. And what our industry struggles with is where you can't identify something and a manager is underperforming.
Brian, could you expand on what a process change is?
Sure.
A value manager buying.
So I'll give you sort of a real life example. We had an emerging market manager in our clients' portfolios called, I won't, just because it's a public meeting, I won't use their name, but and we invested with them for years. And for years they told us, we focus on high quality companies. So companies that have strong brands, that have strong earnings growth, that have, that they've developed their business to have these what are called moats around them. So it's very difficult to compete for other entrants to come into their markets and compete with those companies. They also told us that, we don't buy any of these Chinese internet stocks because they don't have those characteristics of the companies that we typically buy. And then we started to see these Chinese internet stocks get into their portfolio because they were becoming an increasingly large component of the benchmark, and the fact that they didn't own them, they were underperforming as these things were taking off. And when we started to see those kinds of those companies in their portfolio, where they told us that they don't buy those, that caused us concern. So that's an example, I think, it's a real life example of a change in process and a change in strategy. We don't see any of that with Rice Hall James. They are doing what they've always done. Now, it's a relatively concentrated portfolio, so they're gonna pick some bad stocks from time to time, or their process is going to, and their approach is going to take them out of names that really run. If we can attribute the underperformance to that, we're much more likely to give them more runway, because these dynamics and these trends can't persist forever. But the reality is at some point you just get, you get to the point where you say, I can't take it anymore and I'm out. And I don't, it's not a good answer, David, to your question, but it depends. It depends
A lot of
on
factors
That's
involved.
right. That's right. Let me just flip quickly ahead to back to page 21. So these are the new managers that are in place that we added, in some cases, the end of February, in one case with the small cap value manager, the end of March, and how they've done since we've had them in place. So we talked a little bit about Poland and Aristotle, the growth and the value manager. So since inception, Poland, the growth manager's up 3.8. If you go all the way to the far right of this table here, up 3.8%. The Russell 1000 growth index, its benchmark, was up 2.7%. So they've outperformed by 110 basis points. I alluded to Aristotle, being a little bit behind the benchmark. They were basically flat for a month, basically, versus a benchmark that was up 30 basis points. And then for a week, it's a short period of time, but I guess it's worth showing. Delaware, the small cap value manager, there up about 2.7% versus a benchmark of 2.4. So I've talked a fair amount about kind of what's going on, but just to recap, really good result in the first quarter, not only in absolute numbers, up 11%, but relative to a benchmark. And that trend, those strong absolute returns and those strong relative returns, has persisted in the early part of the second quarter. So that's all I was going to say, unless there are any questions that anybody has.
Any questions? Thank you, Brian and Jim.
Thank you.
Thank you.
We appreciate it always. All right, Tom.
All right, thank you. Good morning again, everybody. So we're going to transition over to this handout, the presentation. And I'll move through this information fairly quickly, but just what's contained on page 3 is an update on our product and services roadmap, just recent releases, what's to come. There's some additional information. I'm just going to hit on it briefly on something called My Learning Center. It's a service that existed, has just recently been updated. There's a section in here that provides some plan system level statistics. Most of those we've actually already covered, so that's just there for documentation. And then I'll just, at the end, summarize the expense and revenue update like we generally do, and Brian alluded to a little bit before. On page 4 is just an outline of, similar to the last few years, what I want to come and make sure is being delivered to you all as updates, do it scheduled out, and just give you an awareness of what's happening in the organization and what's being enhanced or offered. As I've said before, with the participant engagement and technology and additional services that we provide for a frozen pension system, not as impactful or meaningful, because generally, for the most part, people are just looking to us to make sure they get their monthly benefits as scheduled. And thankfully, we've done that fairly well over the years we've had you, but just want to make sure that do have an awareness of some things that are available. If we can assist further, how we can do that, and really just to show that we're continuing to invest in the business, whether it's with the pension system or 401k corporate plans. Okay. So behind tab 1, just a couple of things to point out on page 6. So recent enhancements. A couple of things. Something called My Money Connector. It's an aggregation, budgeting, planning service that's available online at no cost to individuals if they want to bring in and create a hub where they can see all their financial information. They can link accounts and then work to build budgeting and planning off of there. That was introduced the end of last year. I talked about also the end of last year a new cybersecurity guarantee that pretty much guarantees any fraudulent activity will step up as long as there's no signs of the individual not acting in a prudent manner in giving away IDs, passwords, et cetera. We'll cover losses there. And then the big enhancement, probably more for Ms. Gooden and Ms. Spivey's team, is we completely refreshed our client website, so how City of Portsmouth back office communicates with us. That system was completely redesigned, and we're working on enhancements going forward this year. On page 7 and 8, so some of the significant items to come. I mentioned my learning center, so I'll talk about that in just a minute, just give you a couple of quick highlights there. You see something on the bottom left, new participant logon slated for third quarter. The participant-facing website will be enhanced, and the look and feel will be modified and updated. Along with that, there'll also be a URL change. We'll continue to redirect using how people have accessed probably for 12 to 18 months at least. But we are enhancing the overall participant website and adding some new features in there. Nothing that will significantly impact pension plans. And then the other item that kind of ties along to it on the bottom right-hand corner is, we've been making a lot of security updates throughout the years, as most financial organizations have been doing. Towards the end of the year, we will start to require that individuals have to provide a cell phone number. We've been collecting and looking to get mobile numbers for the last few years. This change is really being forced by primarily the state of New York, and there's also, I think, state of California, state of Alaska are really moving to more enhanced security protocols where they're looking to require all financial institutions to start picking up mobile numbers as an additional way to authenticate account access for individuals. So, there may be randomly a person or two that still does not have a mobile phone number. They can always still call us if they need assistance, but we will have to start introducing that towards the end of the year. And then on page 8, as I mentioned, we will be further updating the plan sponsor website, enhancing that from a reporting perspective, and we're also enhancing and redesigning our trust statements. All right. In section 2, again, I'm not going to go through this in that great a detail, but just so that there's an awareness to it, we're really taking more and more of this holistic support when it comes to working with individuals. For the most part, they look to where they get their retirement benefits, whether it's a corporation or municipality, as their main point of contact for financial assistance. So we're just looking to build more tools to make things more accessible to individuals. So we have a complete learning center out there that's being enhanced that will just allow a user to go in, set up programs if they want to set up educational programs to learn maybe more, not just about retirement planning, but other ancillary things when it comes along to their financial well-being. That's being enhanced to add in a gamification component. It'll store and track someone's progress and just make the experience that much more improved. For the city, there's really only been a handful of individuals that have gone through this, but again, it's kind of to be expected based on the retirement plan that you offer being frozen, and most people are in pay at this point. Okay, so there's more information here. I won't go through it all here, but just so you have awareness to that enhancement. That was just released about 3 weeks ago. In Section 3, as I mentioned, a lot of these statistics have been referenced. Just one or two things to point out. On page 19, we also show just a listing of assets by investment option quarter by quarter. You'll start to see right in the middle of the page, there's something called the Morgan Stanley Advisory Holding. As I talked about, I think last quarter, maybe the quarter before, we've set up, partnered with Morgan Stanley, the team in New York, to create that consolidated account holding where they'll send us one feed of a value that contains all of the different investment options that'll start to be held over there. So we've worked through that process. We've had a number of phone calls. I think we've got the process pretty locked down at this point. Another piece that goes into that is, as the asset holding increases over there, we've also built a process with them to make sure that adequate money is coming back into a money market fund to pay ongoing monthly benefits and any expenses that get paid from the plan. All right, we can skip through. There's information again that kind of just echoes some of what's already been provided. On page 23, looks at high-level activity for fire and police. No significant changes, really. Monthly annuities payments all stay similar, around $1,900 per quarter. So again, no significant changes, but there's not a lot of actives, and a lot of individuals are already receiving pay. And then duplicate information or similar information for the supplemental system follows that. Any questions? All right, so the last thing, just, again, as we look at on a quarterly basis in tab 4, so Brian did allude to the summary on plan expenses. So there's a page 35, that includes some of this detail. As was mentioned, right now the system has a weighted ratio, expense ratio of down to 39.1 basis points. I did take a look back just 12 months from here, and at the close of the first quarter 2018, the average investment expense for the portfolio was 62 basis points. So you can see through the work Greystone and Morgan Stanley are doing have significantly reduced the investment expense over 23 basis points during that point in time. And then, as I mentioned earlier, our cost of 6.5 basis points is shown there, both in the basis points, and what these dollar amounts represent are projected annual amounts, just based off of the end of the quarter looking forward. And then on the bottom of that page, I did add some additional detail. I think it came up as a question around our agreement. So there are some differences just when the last fee schedule was finalized was just around 5 years ago, but then the city requires, and I'm not sure if this will be the case again, but generally speaking, when we create a service agreement with a client, that service agreement stays in place for the lifetime of our relationship. We'll amend it as necessary, and then we will update fee schedules as fees change. The city, the last time we went through this process, wanted a completely new service agreement. So we provided that. It took some additional time, I think, for review to occur with the city. So the service agreement actually wasn't finalized until 2015. So that's why there was some varying dates here, just to clarify some of that information. Any questions with that?
I do.
Yeah.
So, in terms of John Hancock, when do you believe the contract ends?
Yeah, so we generally work off of fee schedule date, but our fee schedule turns evergreen once it hits what the stated, it's not an expiration period, it's just a period of term. So we know the city likes to use 5-year terms, so that's what we have used. But once we hit July of this year, our fee agreement will remain until the city looks to do their next review. Now, if you want to have a conversation prior to that next review, we can certainly do that, but, you know, generally speaking, those have been done in conjunction.
Okay, because it's, you know, we believe the board was maybe brought up to date last month about what occurred. You have it documented
Right.
here. Is there is a discrepancy in about a year. So if our, you know, our purchasing officer is saying that the 5 years doesn't run out until a year later.
Yeah, he's
That-
working off of the service agreement,
Right.
which is fine.
And so just to make sure I understood what you said, so does that mean that the fee structure stays the same until that 5 years runs, or it stays the same until the 5 years runs from your, what do you call it, signed? So there's two dates there.
Yeah,
Just want to-
so I guess simply said, we will not propose any type of change in our fee schedule until the city goes through the full review.
Okay,
So we'll maintain what we have,
okay.
even though, you know, it's written for a 5-year period in so much as we won't, during that period, go in and modify it unless there are significant changes to, you know, a number of individuals that we service or asset structure, which really wouldn't be the case here.
Okay.
Let me ask you a question,
Yes,
Cheryl. if I
yes.
may. Being the new kid on the block, who makes that request for proposal? The city or this board here?
Well, I do know the last time it was the city. It worked through the city's procurement officer and finance.
And if I might, and that's just operationally, much like the entire board operates through finance and other city departments. But when the time came up for that contract to change, then procurement and the finance department acted to put in a new agreement. So while it's operationally coming through the city, it is, the retirement board is treated somewhat differently than the city.
So the board actually makes the decision who to go with as opposed to...
Correct. The operation is within the board, not within what I would call the city manager.
That's right. We take direction from you. I mean, much like when the investment committee, you know, worked, went through the RFP process just this past year. It was, you know, it was members of the retirement board who made the decisions, and then we as staff, you know, take your direction.
Thank you.
So how much time in advance to the expiration of the contract next year do we need to start the RFP process?
At least 6 months.
So by next summer, we need to...
Yes, I would say
Okay.
so. Yeah, just makes the transition easier if there is a transition. So, you know, it gives you some build in some time there.
All right, and then the last 2 pages just break out by that cost in detail. So I know I've gone through this the last few quarters, but there is just, the one thing I'll add here is, well, let me add 2 comments. So in the middle of the page, expense ratio column, you'll see if you go all the way down to the bottom in blue, it says that I talked about the Morgan Stanley advisory account. So that is the New York team out of with Morgan Stanley provided a blended weighted expense ratio for everything that's held within that account. So that's what that 22 basis points represents, is a blend of all of the holdings there, and that ultimately, when you add in the other fund options that we hold in the trust company at John Hancock, gets you to 39.1 basis points, or 0.391%. And then the second comment is there's still, as of the end of the first quarter, were a couple of investment options that we were holding that are paying revenue sharing. So that is, you know, those columns in the bluish gray color. Those 2 funds were Principal Global Real Estate, and then the Lazard International Equity. We're paying back some revenue sharing into the plan. That totals on an annualized basis around $13,900, and that works to offset that 6.5 basis point cost for us. So again, but as investments change, the revenue sharing may go away. I mean, ultimately, the trust is paying for our cost, whether it's coming from rev share or through the debits of the quarterly invoice. So, any questions? Any other questions with that?
All right.
Thank you.
As always, we appreciate you all coming in and sharing with us. Mr. Ashby?
Madam Chair, members of the board, I just wanted to make you all aware, if you have not heard, the City Council continues, as many of you may have heard, continues to get appeals from certain sets of retirees about increased contributions, of course, during budget season and afterwards. I wanted to make you aware that the City Council is asking for additional information when we get our actuarial report. When you receive your actuarial report in October, they're asking that we report back to them what the actuarial report is in the October timeframe, so they can again determine what they may want to do from their perspective as it relates to retirees. But I think that's the timing they're expecting right now. They want to see what the actuarial report actually says and where the board is and the retirement fund is in general before they entertain any other discussions. And that was as of at least last meeting, but again, it's budget season, so.
Are you referring to the retired firefighters group?
Loosely, yes.
Okay.
And this is them asking for a cost of living adjustment.
Correct.
And we'd, I guess, would we want to ask again what the impact of a change like that would be?
Yes.
I think we delivered that to the board, the council at some point. Although it could change.
We did make a request. So John Hancock, I always forget his last name.
Andre Stewart.
I just know Andre, but Mr. Stewart, we did make a request to them probably about 2-3 weeks ago, and so we're just waiting to get that information back.
Are they still talking about, what was it $500 or $25 a month or $50 a month or something?
It is morphed almost every time it comes. It changes. The last one was $100 a month, and at least my understanding there is it may change again to something else. But the last one I believe was $100 a month, and Mr. Stewart did assist City Council in providing some milestones and implications at that point in time. But for those of you who have been here a while, you know this tends to be a sort of periodic run throughout the various departments and touch points. So the campaign moves on, I'll just say.
In that, wouldn't, even though it may be the retired firemen, persons, whatever you want to call them, firefighters, asking for it, wouldn't they probably approve it for both populations?
Council has expressed a concern about doing something for one and not the rest. Yes, they have expressed some concern about it.
So, am I right? There's like 1,000 participants roughly?
Correct.
So it's like, so $100 would be $100,000 a month, a little over $1 million a year. That's not insignificant.
No.
Certainly. Certainly.
Quick math says.
I'm interested,
Impact.
why would they ask for a dollar amount rather than a percentage of
Usually it is a percentage.
Huh?
It usually is a percentage.
Correct. Your ordinance expresses it as a percentage, not a dollar amount.
COLA, you mean, to me, it's a percentage
Maybe it's
rather
just a
than a
new
dollar.
tax.
If it's a flat dollar amount, certain people are going to benefit more than others.
That is correct.
Yeah.
But we will keep you updated and give you some heads up in terms of where that goes or when that's likely to be a discussion if you all want to either view that discussion or attend.
With Andre's request, to Landon's point, since it's probably going to be both segments, the fire and police, is he giving us a projection for both or just the one?
No, for both.
Okay, good. All right. Any other questions, topics, discussion?
I'll just add one thing. The city is getting ready to sell some bonds. And of course, as part of that process, the retirement program will be reviewed by the rating agencies. So, just want to let you know that's coming up in the next weeks. So by the next meeting, or maybe even July, we might have additional information on how the rating agencies are viewing the retirement plans.
Are those just general obligation bonds?
They're general obligation bonds.
Refinancing stuff?
No, new money.
New money.
Seawall.
Okay.
Well, if there are no other questions or concerns, we thank you all for coming today and enjoy the beginning of summer. Hopefully, especially you guys who are still experiencing snow.
Keep the snow up there, will you?
Take care, everybody.
Thank you.
Oh, move to adjourn?
Second.
All in favor?
Aye.
Aye.